Hello, everyone. I hope you're doing well. So, I don't think any of us really expected this, that our course is online now. So, I know I definitely didn't expect this whole COVID-19 thing to become such a big deal. But here we are, so I figured we should do a week on that. We can kind of use that as a transition into the course being online. So, at this point, we're not really sure of a lot of things. Data in the moment is kind of hard to verify or know how good it is, but so we're not really sure exactly the extent of this thing. We don't know how many people are going to be infected. Some people say, half the global population, maybe. Luckily, it's not a big deal for most people, but it's a very big deal for certain vulnerable groups, the elderly or people with respiratory issues. Death rates, there's a wide range on that right now because of different mortality rates in different places with different resources and different levels of testing and public health intervention. So right now it kind of lands between 3.4 and 0.4%. So it's a pretty wide range. But kind of more in the economic side of it, we don't really know how bad economic conditions will be because of this, and we don't really know if the measures that we're putting in place are going to be enough or quick enough so that healthcare systems won't be over capacity. So let's just turn to the healthcare system for just a moment. Thinking of it in economic terms, we can kind of think of the healthcare system as having like a set capacity, and that capacity is more or less fixed in the short run. So it's just kind of like how a firm can, say, buy more inputs to production, but they can't really change their capital in the short run. So we're kind of stuck with the capacity that we have. And so the emphasis for public health officials has been to flatten the curve. That is, to spread out the number of infections over time so that the healthcare system can kind of deal with them as they come in, rather than them all happening really quickly. This is what has been called the flattening of the curve. A lot of other social policies could help, but kind of at this stage, it's like too little too late. Maybe it would have helped if lower income workers had paid sick leave, or all workers had paid sick leave so that they could stay home if they weren't feeling well. And, there's also the issues of cost barriers to treatment and testing and sheer scarcity of testing. So there's a lot of social policies where economists can have a voice in this, but that might be some way further down the road. What's a little more kind of in our wheelhouse are the markets. And so I'm sure you've all heard about the stock market falling, about the Fed doing just absolutely crazy things, and we're going to talk about some of that. But kind of the punchline to it in the stock market is that it's in turmoil. People are really uncertain about the future. Most stock indices have lost more than 10% of their value over the last couple of weeks. Looking at past pandemics, H1N1 and swine flu, the economic impacts of those were very short-lived, and the rebound was quick, though it did not spring back up to the full height of the pre-pandemic until much later. This one may behave like that, or may be a bit different. It's very difficult to say. People are just selling off assets. We've talked about this earlier in the course of how financial markets, if people start selling off an asset, it falls in value. People expect it to continue to fall in value, and then more people sell the asset. And so that's kind of where we're at right now, is this kind of herding behavior. And so the big two markets that you're kind of hearing about are like the commercial paper market is not really working. And there's also been issues in the market for treasuries, which just usually doesn't happen because U.S. treasuries are considered very, very safe. So in that realm, you can kind of think of it as this collective action problem where people are kind of selling off assets at fire sale prices, and so really the only way to stop that is to rebuild confidence. And so that's what the Fed's been working on. So the Fed has cut the discount rate, or the policy rate, twice in the last week, both outside of their normal schedule. So they didn't wait for the normal meeting to come around. First, they cut it down to, I believe, 1.25%, and now the rate is 0. So banks can borrow money from the Fed for free, basically. Like, they still have to pay back the loans, obviously, but it's free in terms of, like, no interest rate. They've also eliminated reserve requirements, which is just astounding. I don't think that's ever happened before. So, and this isn't for all institutions, but for many depositor institutions, they literally don't have to have any reserves anymore. They extended $1.5 trillion in loans to banks. And so this has, the idea is that they're trying to bolster bank liquidity with all of this extension of credit. This also creates a bit of a issue with the banks, where they could simply use that very cheap money to buy their stocks back, because we talked about stock buybacks earlier in the course, and how firms can do that to, like, help boost their stock value. And the banks have pinky promised not to do that, very informally. I would not be surprised if the Federal Reserve officials made a call to them before then saying, you got to promise me this, but we'll see if that promise holds, because they could simply use this very cheap money to buy back their own stocks to boost their stock price and make themselves appear to be doing much better in the crisis than they actually are. And probably most interesting of all of these measures is another round of quantitative easing. So the Fed has, done this before. Back in the 2008 crisis. They started just buying up assets to help prop up asset values and increase confidence. So this time around, they've already committed to $700 billion in quantitative easing. And so these aren't loans. These are just money that they're going out and they're buying things with. And they're mostly buying treasury bills and mortgage-backed securities. So increasing confidence in mortgage markets, and also in the market for government debt. And those are the two areas where they're focusing. That may change as time goes on. So essentially, monetary economics has gone bonkers. Some people are arguing that the Fed has kind of used all of its ammunition too early. But turning back to some of the stuff that I had to read earlier in the course, it's kind of clear that the Fed has learned their lesson from the 2008 recession, in that they acted very quickly, and they have very quickly moved past the kind of traditional tools of monetary policy into the less traditional tools like quantitative easing. It's clear that they've definitely kind of learned a thing or two from 2008. But the Fed can't really do this alone, as we also talked about in our section on financial crises. Like the 2008 recession, this crisis definitely has a demand component to it, right? Like, lots of people are uncertain about their incomes in the future because they may or may not be out of work. And so it's not likely that people are going to be going out and making a lot of large purchases anytime soon. And so the government can kind of react in like three ways to this. They can act as an employer of last resort to people who are left out of work, which is this very post-Keynesian policy proposal, and I wouldn't really see that as being operative, especially since many people that are going to be out of work are, workers from the service industry, and if you're employing a bunch of people in these massive government programs, you're just going to be crowding more and more people together, and that may not be the best thing during a public health crisis like this. The government could also generate incomes and prop up aggregate demand by just being a demander of last resort, just buying things. I'm also a little bit skeptical of this occurring. But we'll see. It could happen later on. But what has been in the news most lately is the direct payments, right? So I think most prominently, at least for people who are connected to Utah, Mitt Romney has already proposed sending $1,000 check to every adult in the country. So I would not actually be surprised if a policy like this got put forward and made it through. A similar policy made through back in relation to the '08 crisis. So really, I think that's kind of a good guide to what's going on now and what responses are likely to go through. So wanted to wrap this up. I'm just going to keep this short today by talking about price gouging. So we're seeing a lot of this going on, I think most famously with some people that were selling hand sanitizer, masks, and other kind of sanitary medical supplies on Amazon, and Amazon delisting these people. So in the U.S. at least, price gouging is it's handled at the state level. So it's defined differently in each state. Just as a couple of examples here, I've got California, where they've got a very kind of structured definition of increasing prices by more than 10% after an emergency is declared. Tennessee is a little bit looser. It's like charging unreasonable prices for essential goods and services in direct response to a disaster. So there's a little more stretch in that definition, right? But even with that kind of stretchy definition, Tennessee's actually already ordered a man that was hoarding hand sanitizer, as I posted in one of the readings, to cease and desist that action, and Amazon delisted him. So it seems like there's kind of the states are starting to move into action in that regard, and then we've also got private firms and platforms like Amazon that already have a lot of power and don't want to hurt their reputations, who are also delisting these people. So there's a lot of this kind of government and even private action against the price gouging. But economists generally, or at least mostly neoclassical economists, have not been that hard on price gougers. Because really, from that perspective, all that price gougers are doing is they're moving goods from one market to another and selling it at a higher price. And this process of arbitrage, right, of just reselling at a profit, is efficiency enhancing in kind of a general equilibrium model. People with the highest willingness to pay are, at least within the model, going to put that, or going to gain the most utility from the consumption of that commodity. Or if we're talking firms, they're going to generate the most profit from the application of that commodity to their production process. So, really sticking to the paper model, economics is not very critical of price gouging. But especially in situations such as this, where we're not talking about kind of things that are only consumed by people that have a lot of money, but we're talking about daily commodities here. We're talking like hand sanitizer, maybe toilet paper, maybe willingness to pay and ability to pay isn't the greatest way to engage in social allocation. And it seems that society has agreed with this perspective by instituting laws to prevent it. So we can also talk about the hoarding and the strategy of hoarding, and how even if you weren't initially going to be a hoarder, seeing other people, purchasing massive amounts of toilet paper leads to that being the optimal strategy. But I want to keep it kind of short today. So let's just kind of sum up. There's a lot of uncertainty. We don't know everything. Healthcare system capacity is a huge concern right now, that insofar as economists are, studying allocation, they might have some things to say about that, and we should all be doing what we can to, say, flatten the curve. A lot of this uncertainty is leading to financial markets tanking because people are uncertain about the future. The Feds responded quickly, but if any sort of response to this is going to be effective in, say, preventing or alleviating the worst effects of recession, fiscal policy's got to get in there real soon. And we're already hearing about that very quickly, which is reassuring to me at least. And finally, we've got uncertainty about future conditions for individuals means that they're engaging in some behavior that may be individually rational, but it might be socially suboptimal. So, probably wash your hands. Thanks.